Hi, I'm Sharon Winsmith, a tax attorney, active investor, and your go-to resource for proven investment and tax planning strategies. In this video, I'm going to talk to you about why I personally think the only good way to invest is by using long-term investment strategies. What do I mean when I say long-term? I mean investments that I'm happy to own for 5 to 10 years. In some cases, I buy investments that I never plan to sell in my lifetime. I may borrow against those investments in the future. I may use those assets as collateral to buy other investments, but I have no intention of ever selling those assets. That's what I mean when I say long term. I never buy or invest in something that I'm not happy to own for the long term, for years and years and years, depending on what type of investment that can be. That can be several years into the future. So you need to understand that to be a good investor with, employing long-term investment strategies, you've got to be disciplined. You've got to be able to ignore what you hear in the news and what you hear all the so-called market experts saying. You have to stick to your strategy and be able to implement and stick to your guns for the long term. What are examples of good long-term investment strategies that I use? I talk a lot about buy, borrow, die. That is, I think, the best tax and investment strategy out there. If you don't know about it, you should watch my other videos where I talk about that. That is a great long-term investment strategy. Also, there's good strategies around real estate investing where you can own real estate for 5 years, 10 years, or even as long as you want to in the future. You can do things like 1031 like-kind exchanges and just keep scaling up those properties and just use that strategy indefinitely. I also like to invest in, start, or buy businesses that are sustainable. So businesses that are really brands and that can outlast and live several years into the future. I don't like to do things that I think are more short-term focused. So what are short-term strategies that I don't do? Things like short-term short selling stocks. I don't do that. I don't believe in it. I don't have a moral issue with shorting stocks, but I just don't believe in that strategy is a good idea. And also things like stock picking. I am very anti-stock picking. I don't think it's a good long-term strategy, whereas you might be happy to own a company now. Are you going to be happy to own that company several years into the future? So if you think about something like a good company like Apple, yeah, I would be happy to own Apple or shares of Apple right now, but is Apple going to be a good company, 30, 40, 50 years into the future when I still own that stock? I don't know. I'm not a fortune teller, so I can't predict the future, but I don't care because I'm not stock picking. I'm investing in things like S&P index funds where I'm happy to own those index funds for the rest of my life, whereas I may or may not be happy to own something like Apple or individual companies. This makes that point irrelevant because I'm not owning or doing stock picking, which I think is a really bad strategy and definitely not long-term investing. Other things like derivatives and things like that you hear a lot of people talk about to make a quick buck. Anything where you think you're going to make money in the short term, I don't do it. I don't think it's a good philosophy, and it's just not something that I believe in from an investment standpoint. So with that said, I want to talk to you a little bit about why I think that long-term investment strategies are the best way to think about how to invest your money. So to start with, and I'm just going to run through these 9 reasons that I put together. Some of these I think are pretty obvious, but when you do long-term investing, you have better planning and predictability. So you can put a good strategy in place from day one and you can stick to it. You've got to be disciplined. You've got to be able to ignore what you hear in the media or the mainstream, news channels telling you whatever those so-called market experts say. You've got to be able to put all that out and stick to your strategy. It allows for you to make smart decisions. You're not acting based on your emotions, and you can also easily diversify your investments because you have a plan. And you're not, investing something today that you don't know what that's going to look like in a couple of years. You don't care what it looks like in a couple of years because this is a long-term investment. What you're doing is you're sticking to your plan that you have in place. It also allows you, because you are very disciplined and you are acting with, good resolve. You're not doing something that's emotionally charged or making trades based on, what you're hearing in the news. This allows you to take advantage of good investments when they're available. So you have a plan in place. You can predict how things are going to unfold. No, you don't know what the market's going to look like, but you don't care, right? Because you're not focused on the short term. You don't care what the market looks like today. You don't care what it looks like tomorrow. You care what it looks like, 5, 10 plus years into the future. The second reason I hate short-term investment strategies is that you cannot time markets. Anyone who tells you that you can time markets is wrong. There is absolutely no one out there who is what I would call a thought leader or a very successful investor. When you think about the most successful investors like Warren Buffett, Ray Dalio, all of the people out there, Nobody says you can time markets. Anyone who tells you that, you should just ignore everything else that comes out of their mouth, because you cannot time markets. That has been proven time and time again. So I'm not going to beat that up anymore, but that is important. When you do short-term investing, you are timing markets. So you are telling yourself, I can time this market. Regardless of what you think you're doing, that's what you're doing, and you cannot time markets. Number 3 is the beauty of compounding. So compounding, I'm assuming we all know what compounding is the thought that, the sooner you get your money invested and the longer it's invested, the more money you can make in the future. So if you are doing those long-term investments with very long-term horizons, that money is staying invested and you're compounding from day one, indefinitely until you do decide to dispose of that investment, or, for the rest of your life, if you're like me and a lot of your investments are really lifetime investments. Number 4, and this is kind of similar to compounding, is you have almost 100% of your money invested at all times. So as I said, you've got a plan in place. You've got a strategy that you're going to stick to. So you're keeping your money invested at all times, and you're taking full advantage of compounding, because almost 100% of your money, I would say on any given time, very close to 100% of my money is invested at all times. That's just the strategies I use. I don't like to hold things in cash because, again, if you're holding cash, you're timing markets. And I'm not a fan of that strategy. I want 100% of my money invested at all times. I don't care if the market goes down tomorrow, again, because it's going to go up. It's always gone up historically, and it's going to keep going up. And I want to always be able to take advantage of those upsides and that steady, progression upward a long time. Also, you avoid taxes from sales. So you don't pay tax if you don't sell an asset. You may get income or cash flow from investment. Like, for example, if you own stocks, you're going to get dividend income. Yes, you're going to pay tax on that if you don't, unless you do other tax planning strategies, which I do, have other tax planning strategies to reduce the tax on dividend income. But you're going to, pay taxes if you sell assets. So with a long-term strategy, you're not paying tax. With my investments that I own for lifetime, I'm never going to pay a dime of tax on those because I do the buy, borrow, die strategy. So I am not going to pay tax on those for the rest of my life, income tax. So, if I don't sell an asset, I don't pay tax. And I think that gets lost in the fold a lot with this stuff, is that if you do short-term trading, you might be making good returns, for a short term until the strategy doesn't work, because short-term strategies just never work in the long term. They always prove not to be successful, and they just never have long-term sustainability. But let's say you do make some bucks, doing some trades, shorting a stock or something, the market goes down, you get lucky. So you're going to pay tax on that. You can't do short-term strategies without selling or trading. You've got to pay tax at that point. So when you factor in taxes, and this is important when it comes to stock picking, like I said, you probably don't want to own, Apple, I don't know what it's going to be like. There may come a time where I would sell those shares if I did stock picking. So I pay tax at that point, and I pay tax at a very high rate. Don't be under the misconception that capital gains rates are good. They're not. If you're going to keep paying capital gains tax on your earnings over your lifetime, that is going to eat in significantly to your lifetime earning potential on that money. So I hate paying taxes, especially taxes on investments. So I do everything I can to avoid taxes, and a good long-term strategy. You can plan for taxes. You can implement tax planning strategies, or in some cases, you might be able to own assets for your life that you just never have to really worry about paying a lot of tax on. Number 6, this is also a tax concept, is that you get a step up in basis on assets. So this is also, product of the buy, borrow, die strategy, where you own assets for life and then you die and get a step up in basis. If you're not familiar with the step up in basis concept, you should be. Leave a comment below. I don't know. Sometimes I make assumptions on what you all kind of already know and don't know. If you don't know about step up in basis, I'm happy to record a different video, and go into that in detail. So just, put something in the comments if there's ever a topic you want me to dive into further. But step up in basis of assets means that if you own that asset, when you die, your heirs, whoever you leave that asset to, they get to step up the basis. So the income tax that you would have had to be paid on the appreciation in that asset just goes away. Nobody's paying any income tax on that. So that is a powerful, if not one of the most powerful tax planning tools available to you, is to own assets for life. Now, I know you're not going to, there's not every asset that I own that I would own for the rest of my life. So it's not a strategy that you can always do, but it's definitely a strategy you can do with certain types of investments that you're happy to own for the rest of your life. And you can get a step up in basis and just eliminate any income tax that anybody ever has to pay on that asset. Number 7 is also, this is very, very important, is that with a long-term strategy, you force yourself to be disciplined. So you're avoiding trading based on emotions or short-term sentiments. right now, as I'm recording this, 6 months ago, everybody was predicting a recession. If I had listened to, anybody on CNBC or just any of the big bankers, I would have sold all my shares. I would have gotten out of, sold my S&P 500 index funds. I would have gotten out of the stock market because doomsday is about to happen. Well, that hasn't happened. We've actually had, pretty good gains over the past few months or in some cases. So you can't trade based on what you hear in the news. You can't trade based on, what your friend tells you, what your buddy's telling you that they predict. It doesn't matter how smart the person is. Actually, the people who predict and make predictions are usually the people you don't want to listen to. So never trade based on short-term sentiments. I know a lot of people who lost a lot of money on Bitcoin because they bought it when it was going up and it was really popular and everybody wanted to own Bitcoin. It was the coolest thing to have. And that's actually the time you most, least would want to buy the asset. But again, a lot of people got scared when it started going down and they sold it. So that is trading based on emotions. That is, trading based on short-term sentiments around a market or an asset. And that is a guaranteed way to lose money as quick as possible. So that, I think, is one of the worst things you can do. So one of the best things about a long-term investment strategy is that you don't care what the current situation is like. I don't care what, at the time I'm recording this, we're still in crypto winter. So I don't care about the value of my crypto today, tomorrow. I care about what it is 30, 40 years from now, because that's where I think the time it will take to reach the full potential of blockchain technology. So again, this is very important. You got to make sure you have a plan in place that you're not trading based on emotions, because that's always a bad idea. Number 8 is that there's always historically good market resilience in most asset classes. That is not the case for everything, but typically if you look at the stock market, so if you invest in something like S&P 500, historically it always goes up. Yes, there have been dips. There have been really bad recessions. When I graduated college, it was the 2008 recession. It was absolutely awful job market. It was probably the worst time to be coming out, into the labor force trying to get a job. So I know firsthand how bad that was, but it came back, and it came back a lot. We had a big dip, a recession there with COVID. The stock market just tanked. But it came back, and it's already, so the stock market always comes back. And that's the same with other markets. Historically, real estate goes up. It doesn't go up a lot, but historically, you have market resilience in a lot of asset classes. So that's something important. And if you're a long-term investor, you're taking advantage of that. But if you're a short-term, you may or may not be missing out on that. It's all about luck of the draw if you do short-term trading, because you might be trading when the market was down, or you might be trading when it's higher. And absolutely nobody knows what the market's going to do tomorrow. Nobody can predict. If there's anything about the stock market, for example, is that one truth to it is that it is completely irrational and it doesn't make a lot of sense in a lot of cases. So nobody has ever on a long-term basis been able to predict markets. So just the idea that you're going to try to trade based on, what it is today and not, be a fortune teller and guess what it's going to be tomorrow, that's always a bad idea and always a losing strategy. Last, and I think this is very important, this is certainly something that was very important for me when I was really starting to learn about investing, is that absolutely every leader in the industry that I cared about, from Warren Buffett to anybody I read, basically any finance investment book I've ever read, nobody has ever said anything other than the fact that good strategies are long-term investment strategies. Now, people may disagree on what long-term investment strategies mean or what strategies they use for that, but nobody with any sense in this field is going to come out and tell you that short-term trading can work. Everybody that has any sense, look no further than Warren Buffett, who is going to tell you that the best way to invest is to be a long-term patient investor, invest in assets for several years, don't trade based on short-term sentiments, always employ good discipline, and always think about things in a very long-term horizon. So this is just in a nutshell, my 9 reasons why I think long-term investing is very important. I think that a lot of people, or at least most people I talk to, agree with that. But at the same time, they then go do things that aren't long-term, like stock picking, or sell their stocks when they think there's going to be a recession. So you may tell yourself, yes, I agree, long-term investing makes sense. It is the right way to go. But are you really doing that? Are you really using strategies like buy, borrow, die? Are you doing real estate investing in a smart way that you're taking advantage of long-term investment and tax planning that you can do there? Are you doing stock picking, or are you investing in things like S&P 500 index funds where you're happy to own those for several years out into the future or potentially indefinitely? So hopefully this is just, a good refresher for most of you and you agree with the sentiment. But if you, are someone who watches my YouTube videos or anything I talk about, I am never going to talk about an investment or tax planning strategy that does not take into account the thought or the underlying thought that this is a long-term investment I am making. So if you're someone who just disagrees with long-term investing, this is not the place for you, because I strongly am very much a proponent of making investments for very much the long term. I want to own those things for years. I never want to own something that I'm not happy to hold that asset for 10 plus years into the future. So hopefully you found this video helpful. If you did, please like the video and subscribe to the channel.